Check, 2, 2. Okay, let's get started. 2 minutes late today. Got a lot to cover today. The first thing is I've freed up space on the iDrive to copy your assignments over. It's easy to free up space there. Just what I do is delete all the MP3 files. Okay. So that's ready to go. Just to be real clear, I will post the new assignment number 5 Thursday, 1 p.m. Okay, I sent multiple emails about this. What's up there is last year's assignment number 5. The same style. You write 2 pages, and it can't be ultra small font, right? I think it's 12 point is the smallest size, something like that. Should not take that long to do. It's an overview situation. I will also spend the second half of today's lecture kind of reviewing the course. Thursday, we will do the group presentations, and you've got, and it really has to be tight to 10 minutes, okay? And you need to allow for some questions from me in particular. So we'll have five groups go before the break, then we'll take the break, and then we'll have 4 groups go afterwards. Then I need a few minutes right at the end, okay? Like maybe 15 minutes right at the end. I will email you probably tomorrow the order of presentations. And it needs to be really smooth in terms of switching. So everything's got to be loaded up, ready to go. Okay? So today, what I'd like to do in the first half, the actual topic is international hedge funds. But I wanted to take at least some time at the beginning to revisit what I introduced in the second lecture in terms of this idea for Forex trading called forexter.com. And I've got with me today two of my partners, Nathan Bronson and Scott Harrington, who I guess we've worked together for how many years? 5. Yeah, at least 5 years. And they're also involved with the hedge funds that we've got operating. And we might actually, because we're talking about international hedge funds, we'll show you a bit about that also after we go through the demonstration. So that's kind of like the plan for the first half. Show you this FX thing, and then talk a bit about high-frequency trading and hedge funds. Okay? Okay, well, I guess probably what we're going to do is to show the institution-to-institution sort of software that we've developed for executing. So, Nate, do you want to?
Thanks. What we're going to show, what we've got set up here is I've got a server running on my laptop, and we have another laptop here, and so we can demonstrate kind of the way it would work if you had multiple institutions trading with each other. In all of our graphs here, the notation that we're using is a white node is a fund, just some sort of institution, not a bank, a fund, a corporate. A bank would be a black node, and then we got arrows because everybody has credit relationships with each other. And then the arrows can also demonstrate the position that people have with each other. So the scenario that we've got going right now is 3 different funds connected to one bank. This is the way that things would normally be done, except that in the normal business, the funds have to call the bank, and the bank would offer them a particular price, and they have to either take it or reject it. What we're going to demonstrate first is 2 funds trading directly with each other. So I've got the red node up here. This is the order book that they would be seeing. So they're seeing on the euro market 88 to 93, and there's some depth there. These were put into the market by the hedge fund 53. So hedge fund 53, even though it's a hedge fund, is actually acting as a market maker. So our system allows, the difference with our system is that it manages the credit overall. Like if you actually had this picture of everybody's positions and everybody's credit, that would be a very valuable and illegal thing. It's just up here for demonstration purposes, but it's kind of illustrates what's going on. So go ahead and we'll trade from 46 to 53. And what we'll see is that the system, because it's managing the credit at a large scale, it knows everybody's positions. If we do it again, we'll see that the credit pipeline, or the maximum position limits between 46 and its host bank will fill up. It will no longer be able to see the trades that other people are posting. So the system allows everybody to operate as if they had a regular limit order book, except that it will actually be tailored to each individual person. For example, another system that actually had more liquidity available, in this case, our pipelines are full for both 46 and 53. So this node can no longer post offers, and 46 can no longer take offers, so they don't see them. We'll switch to a second scenario, which this scenario is it's one way of taking advantage of our system. It provides the customers a single bank can offer this as kind of a value added to let their customers trade with each other, and just act as an intermediate. Another possible scenario, which is what we're actually trying to do as our hedge fund, is to have one fund trading with several banks. At kind of a macro level, this is somewhat analogous to at a macro level, this would be somewhat analogous, or provides somewhat the same thing that kind of an FX all would, in terms of allowing you to trade with multiple banks simultaneously or get a better quote. The difference being that in this situation, the fund itself is actually posting, I think it's further over to the right. Yeah, there we go. The fund itself is actually posting the orders and the banks are taking it instead of, so it's a reverse auction instead of a forward auction, which it provides theoretical benefits for the customer. The banks perhaps don't make as large a spread on it, but that's the way that the markets eventually trend to, is to favor the customer.
Nate, you mentioned FXall, and people might not be familiar with what that is.
FXall is a industry consortium that allows you to post a size and then receive multiple quotes from a bank, from multiple banks. But they have to be banks that you've already set up credit relationships with, so it's not really any different than the current setup in terms of having to have everybody have credit with everybody else. And for example, if you have credit relationships with only 3 banks, you're only going to be getting quotes from those 3 banks. And I'll get back to that issue in a little bit after we combine this scenario with the previous scenario. So in this scenario, we have one fund, and it's posting. Okay, so the fund is posting that it bids, it wants to buy.
This is the order book that the funds trade.
Right. This order book is the order book that the funds trader would see. The left side are bids that have been posted by the trader itself, and the right side is just something that's posted by one of the banks. So the bank is actually able to see in a limited order book type scenario what the fund wants to do, and then it can either take it or not. So in a situation like this, you would have a trader at the bank with an EBS terminal on one side, a Forexer terminal on the other side, and if he wants to, he can essentially arbitrage between the two.
Back up here. As the fund here, I want to buy euro. I have a total of 12 million euro on the book. I'm willing to pay 90.95 cents for my largest bid, and then I have some other bids behind that. So what I'm hoping is that one of the banks that I have a credit relationship with is going to hit me. Right now the market may be higher than this, but that's the most I'm willing to pay is 90.95. And I can work these positions. The trader's job would be to obviously to move these orders closer to the market if I really need the euro and I'm willing to pay for it, or to move my orders away from the market if I think the market's going to move in my direction.
Okay, I've got pulled up on my laptop here what one bank would see, and the bottom thing here is what a different bank would see. So what we can do is we can actually compete for the order. So
which bank are you?
I am bank 49, which is on the middle node there.
Okay, and this is the book that a trader at bank 49 would see. So I'm bank 49.
I should pull up a different bank then.
We would be traders at the same bank competing here. It might not be a good idea.
Which is possible, though.
Sure.
It's totally possible.
You could be in London and I could be in New York. So I have an order book for bank 49 here. And I see this 90.95 bid by some client of mine. I actually know here, since we only have one client on the screen, who it is. But
okay, I've logged in now as bank 56, so we're going to compete for this, compete for the flow.
So you're going to...
Whenever you're ready.
Okay, I'm going to go for it.
So one of us will get it, and one of us won't. I got it. So his turned red because I clicked faster than he did.
So now if I wanted to trade again, there's more liquidity at this price. I could.
So it's just a matter of the speed.
It's just a matter of transactional integrity. It's not anything that you wouldn't expect, but it's something that doesn't always happen with a lot of systems. What I want to show you now, you zoom out to the full graph. Both of these systems, this is very nice for a hedge fund if you can convince a bank to do this, because you can have a system, a graphical system, kind of like a traditional system that we're showing here, to have an actual physical trader place trades. But what we as a hedge fund are really interested in the long run is having our system, our computers themselves do the trading. So in a reverse auction model, our systems have a lot more flexibility. The computer can't pick up the phone and call, and the computer doesn't want to constantly be pulling an existing system to get quotes in order to have good price discovery. So if we can actually push a reverse auction then the computer models have a lot more equal footing with a regular trader. So for a system like this, almost any forthcoming system is going to have a computer API, so you can hook into it with computerized trading models, or else just hook into the traditional trader UI. What we're seeing on the screen now is the end result of both a reverse auction with one bank with many customers and a reverse auction with one customer and many banks, which is to hook everybody together, banks, customers, into a credit graph. The end result, the idea is that because everybody actually has credit relationships with everybody at a 2 or 3 or n degree of separation, that it's not necessary for everybody to only trade with their immediate neighbor. Like this node doesn't necessarily have to only trade with this bank, which is what it has to do now. But if you have a system that can keep track of the credit relationships and the actual position limits on a large scale, then you can have the end nodes trade direct with each other. And then it just becomes a back office exercise to get the money from one end to the other. So what this allows is that it gives everybody something that appears to be a centralized limited order book, but is actually, if you're a mathematician, then you can think of a continuously differentiable manifold. Everybody has something that looks like a limited order book, but everybody has their own personalized limited order book that shows them only the things that they have the credit relationships to see, and that their position limits allow them to trade at this moment. And it's all done in real time. Any particular questions? Or?
Yeah, so how much, this looks pretty complex just as a graph, but how much complexity could this actually take in terms of...
how much can the system handle?
Yeah, exactly.
The underlying algorithms, depending on how much you want to spend on a computer, can handle about 1,000 nodes, customers, with what we've got now. Presumably that'll scale up. Moore's Law helps out there, but Moore's Law being the relationship between the 18 months computer speed at a given cost levels.
So,
what we're showing here is about...
so the version that we've got right now is like, could handle 1,000.
Yeah, I mean, I'm running 80 nodes off my laptop, and it's not even a new laptop, so...
Okay, cool. And what about, talk a bit about FXall versus what we're doing here again.
In FXall scenario is that if I, as a fund, want to trade, what I do is I go on the FXall site and I say, okay, I'm wanting to buy 10 million euro. And that goes to the banks that I've already pre-configured, and then they send me back a price, and I can either take it or not. And that price will depend on my credit relationship, my standing with the bank, the size of my order. It also makes it more difficult for price discovery, because whenever I want to actually, if I'm just thinking about trading, like if I'm willing to trade at 95 and the market is around there, then I have to constantly pull FXall until I finally get back that price. Whereas in a reverse auction framework, if you're willing to trade at 95, you just put an offer in there for 95, and then if somebody else is willing to trade at that, they will. And if they're not, then they won't. It's a completely different scenario. Priceline.com would be an example.
How big, not being a small hedge fund manager, how big a problem is this for small hedge fund managers? How many kind of are out there in this? I would imagine if you're a large institution, you've probably got many credit relationships, and you get pretty good, as good a price discovery as you're going to get.
We typically figure we lose maybe $100 per trade per million, just to the spreads. So there's a lot of room to play with there in terms of if we can cut the spreads to zero, then as a revenue model, like we have at least $100 per million to work with to make it more efficient for the small hedge fund.
How much would someone who is a larger player lose per node? Also 100 or much less?
Well, I think you'd have to have your trading strategy would determine whether you can actually improve your execution or not. I think one of our goals is for the larger players, they can actually make a market. They can make the price and make the banks hit their price, which currently isn't possible. And there are larger hedge funds and institutions who would be willing to provide liquidity instead of just hit the bank's prices.
More than willing or anxious to.
Yeah, the the banks currently, since they're the only ones who can make markets, have a lock on the ability to I mean, they get the spread all the time. But any large institution who's willing to make markets in foreign exchange, or any, for us in particular, foreign exchange, can make those profits that the banks currently have a monopoly on.
But what's limited them? Is it it's technology that's limited them, relationships that's limited them, or regulations that's limited them from anyone from making that market?
It's just tradition. I mean, well, you can probably talk more to the history of it than I can.
It's tradition, but it's people are talking like quite actively that tradition's going to change abruptly.
All
Everybody
the
realizes
talk
it.
to agree that this is going to happen in one form or another. It's just a matter of when nobody wants it to happen, but everybody knows it's going to. So
That's not true. The sell side doesn't want it to happen, meaning banks, because
that's true.
it's a cash cow for the sell side. But the buy side, institutions, funds, corporate treasuries, it remains to be seen whether or not they'll get better execution. But we think they will, and they seem to think they will also. So we can build it and see if it works.
What are your risks in terms of facilitating this transfer or communication between individual buyers, and how do you mitigate those?
Well, from a financial standpoint, we're not actually operating as a centralized market because we're not actually, the credit relationships are exactly the same as they are now, and the money is still flowing the same as now. And the back office settlement, if somebody defaults, like the procedures that you go through to clear that are all the same as they are now. So we're actually more operating, I guess technically, the word is a room that people can come together and meet in. From a security standpoint, the information that is in our servers would be very valuable. So that's an engineering problem. The two solutions that we've handled there are, one, each of the individual banks is only informed of the information that pertains to its immediate neighbors. So for example, if this node was involved in a trade that went through it, it would only be given information about its immediate portion on the path. And then you have to have you wouldn't be able to put it together unless you had a larger picture. And we use public and private key encryption at the database level. So there's a key for the day, so you can't actually access things during the day. The private key is stored elsewhere. And then it's only at the end of the day that you actually can go back in and audit all the records to verify everything. But it wouldn't be possible for somebody to analyze that in real time. And in fact, it wouldn't even be possible, like even if you had access to the server, it wouldn't be possible to analyze it in real time.
So you're saying you couldn't access it in real time?
Well, as the designer of the system, I could never design it so that I couldn't have designed it so I could get in. But I have designed it so that even if I just went down and sat down at the system, I wouldn't actually be able to get the full information out.
Question at the back?
Is there any conflict of interest here, since you're only given so much information to each of the parties involved here, but you have all the information for all the parties involved, and you're going to be trading on it?
Well, definitely there's a conflict of interest between the fact that we're currently a hedge fund and we're trying to do this. But the reason we're doing it, we actually developed the system because we wanted to do this model, and then we decided that this might be something that other people would want. Yes, and the answer is that if this thing actually works, we'll probably shut down the hedge fund because this has the potential to be much larger.
Yeah. So right now, we'll see what happens. We're quite excited about the possibilities for this, and we've got a huge amount of interest, and actually advanced negotiations with a number of strategic partners. But you're right. Obviously, there would have to be some separation. There is a conflict of interest that we recognize.
This screen would not be available to any participant.
Right.
Or not to anybody at all. It won't even exist in the final thing.
Any other questions on this? Yes.
Do you see, since now large hedge funds will be managing like credit risk, is that the case? Do you anticipate like higher default levels?
Well, the credit risk is actually, like each credit risk is only with the bank that the hedge fund already has credit relationships with. The fact that they can place orders on both sides of the book, the bank that is guaranteeing them has already evaluated them for creditworthiness. So whatever the credit rating of that bank is, you only have to, at the global level, even though you're trading with people that are far off, you as an instrument, I mean as an institution, only have to worry about the credit relationship of the banks that you're connected to, because they are guaranteeing the bank that is guaranteeing the fund that's on the other end. So in order for a default to actually affect you, all of the banks in the middle would also have to default, which is it's not any different than the scenario as it is today. The only difference is that you can essentially think of this as 3 or 4 virtual trades that are all happening as one atomic transaction that connect you to the other end. It's no different than it is today, except that today there's 3 trades that occur separately, each of which has a spread on it that is against your favor. It'll increase the number of small trades in the middle levels, but it won't actually increase it doesn't change the actual net transaction volume in any way.
Well, other than the fact that if the prices are like more efficient.
If the prices are better, people may trade more often.
Exactly.
It would increase the number of trades.
That's right. So you might be rebalancing more often for hedging, whatever. If you're faced with much lower transactions costs. And as you said, it's roughly $100 on the bid-ask spread for $1 million trade. If that is eliminated, then
That's the minimum.
Yeah.
One pitch.
yeah. If that's eliminated, then there could be more trading. Yes.
Can you go back up on this graph from the top part again? In this particular model, then, like would bank or would the corporate 201 be able to trade with 2601 down at the bottom?
In this particular graph, because it's connected, everybody can trade with everybody.
But you'd have to go through 4 different credit relationships within the banks to get there?
There was 201 to, where was it?
2601. for instance.
2601. You'd have to go through 3 different banks in this scenario, yes. And as with the back office scenario that the banks typically have now, that's prohibitively costly because essentially every trade is confirmed by voice at the end of the day. So one of the things that will be required in order to make this happen is automated integration into the back end, so that our system can interact with the banks and essentially check out at the end of the day without having to have lots of user interaction.
For instance, in this situation, why would 1901 want to even participate?
1901 is a bank, which means banks can also trade as
Sure.
as
But
traders.
why would they want to participate between a trade between 2601 and 21? Are they going to get paid for this? Or?
Yes, they will get paid for it. They won't get paid as much as a spread in a current transaction, but they will get paid some. So what we're doing is we're switching it from a spread fee model to a transaction fee model, and then the transaction fee is split among various. There's a clearing fee for the end nodes, and then it's a credit path compensation fee for the intervening nodes.
Which they get already, right? So we wouldn't, like the largest part of what they make is off the bid-ask spread, and they get a transaction fee. And given the automation, they would still retain the transaction fee, though it might be split amongst many different banks.
Right.
So there's an incentive to actually do this. In a large volume, that can be a lot of money, but it's not going to be nearly as much as the $100. Yes.
Since banks are still key factors in this whole game, I mean, what prevents them from, okay, they don't get the spread anymore, but they still have this, almost a monopoly over the transaction part, because that's the transaction gets closed, and they can just kind of do one for another.
So they could bump their transactions fees from $5 to $50, let's say.
Or even more. I mean, if that's their core competence,
Yeah.
and the value they provide.
So what happens? What do you think would happen if they tried to pull something like that?
That's what I was wondering.
It's a competitive market. I mean, if you can, once you're abstracting away the value-added services stuff, then you end up with a commodity market. So competition will drive the price down.
Yeah, I would think so.
At least that's the idea.
But do you think if you're changing the value chain in a way that the value provided by the transaction increases, because that's what they can offer as part of their core competence, nobody else can.
But if you can trade with anybody in the world through some small bank, instead of, like as it is now, if you want to get good prices, you have to have credit relationships with the big banks. even if you're a bank, if you as a bank want to get a good price on EBS, you have to have a credit relationship with the big banks. Whereas in our scenario, if you as a customer can hook up with a small bank and still get good quotes because of this multi-hop scenario, then that actually increases dramatically the number of choices that you have for who you can trade with, which would increase the competition in the market.
So there is a scenario where those fees actually go up, but in the end, even if they doubled, it would be just a huge savings in the market. And I'm not even convinced that that would happen. Indeed, it could be the opposite. As this becomes more electronic, and there is a lot of competition out there, that the fee could actually go down. So it's a real specter for a lot of these banks, because this is, Scott, I think you said cash cow, a real cash cow. And everybody realizes that it's not going to be around in the traditional way. And this is like one of the models.
I guess part of what I'm struggling with is do you think it's tacit collusion that's kept these spreads so high? Is that your theory? Because you don't need 20 banks to have competition. I mean, there's 3 airlines, you get competition if they're not colluding.
Yeah, we probably shouldn't, give an opinion like that or get in a lot of trouble. I think that you can look in the past to many different situations like this where there's been something that's been very profitable and nobody kind of innovates because of the fear of that profitability disappearing. And, it's hard to explain it, and I got to be careful, obviously, what I say. But there have historically been other situations like this where basically this is going to be commoditized, as Nate said. And the question is, if you're the bank, what do you do? Do you resist, or do you jump in to be the first in? So it's a real strategy issue. Any other questions on this? Okay, so let's switch gears. That's I'll talk about hedge fund then.
Okay.
Yeah. Okay. What I thought I would do, I usually do this for at least half a lecture, just talk about the stuff that I do. Hopefully you don't mind. Some people keep it secret, but it's exciting to me because a lot of this is it's kind of like the implementation of the stuff that you do as an academic sometimes. And there's one thing getting a publication in the Journal of Finance, but there's something else when your trading system is implemented in real time, and you see the stuff actually happening. So for me, I guess my utility function has got publications in the Journal of Finance, which I've done before, but it's also trying to impact what's happening in the real world. And I'll tell you a story, basically, how I got onto high frequency. Actually, I've got one of the very early papers using high frequency futures data. It was, I went to a conference at the Chicago Board of Trade, and to do what I wanted to do, I really needed the transactions data, the tick data. And I secured that data, and it was, at the time, very difficult to manage. And it turns out, actually, that I did Arch and Arch-like tests for heteroscedasticity on these data, and it was like the first tests on FX to actually do that. So I've been interested in high-frequency data for quite a while. And there was the situation where the computing power just wasn't there to handle a lot of this stuff. And just by chance, I guess, one day a student from computer science came to my office. His name's Armand Gladio. And he sat down. He was computer science at Duke in the master's program. And he was thinking of transferring to finance. So I said, what sort of problems do you work on in computer science? Because I wanted to see if there was some possible linkage from computer science to finance. And he described two problems that I thought were pretty interesting. One was a problem called caching, where, and these guys are much better at explaining than I am, but the question of when to write out to the hard disk. You don't want your cache to fill up to 100% because it would be inefficient. And that to me seemed like a forecasting problem. And I'm looking for forecasting applications. And the other thing that he mentioned was the idea of data compression. And Duke's computer science department is highly mathematically oriented, and kind of went through and described. He described to me, the theory of data compression, which I didn't know at the time, and that's what I'm going to do right now, just to show you a very simple compression and show you kind of the genesis of our idea for high-frequency trading. Okay, so how many have done this sort of stuff before in computer science? You've all used like zip stuff, but do you actually know how it works? You do, okay, couple. Okay, well let me just fumble through. And basically what I'm going to do is write down what could be words or graphics, MP3 file, whatever. It's going to be represented in terms of zeros and ones. And we get a string of zeros and ones. Let me just actually zoom out. So let's Okay, so here's just a string of zeros and ones. And what we're going to do is we're going to build a tree with these zeros and ones. Okay, and we'll look for unique combinations. That's the first thing. So 1 is unique. 0 is unique. 1 we've seen before, but we haven't seen a 1, 1. 0 we've seen. Stop me if I make a mistake here. 0 we've seen, but 0, 1 we haven't seen. We've seen a 1, but we've not seen a 1, 0. Seen a 0, but we've not seen a 0, 0. We've seen a 1, 0, but we haven't seen a 1, 0, 1. We've seen a 0 and a 1, but we've not seen a 0, 1, 1. Is that correct? No, we've seen a 0, 1 here, but we haven't seen the string of 0, 1, 1. Is that correct? Okay. We've seen 0, 0, but we've not seen 0, 0, 1. Right? We've seen 1, 1, but we haven't seen 1, 1, 1. So that's kind of our last one. Okay, so now I'm going to build a simple tree with these data, starting at point right here. And any time that I see a 1, I'm going to go to the right, and a 0, I'm going to go to the left. And I'm going to keep track. Okay, so the first one is a 1. And I'm going to keep track of that visit to this node. The next one is a 0. Go out here, and again, keep track. That just means to keep track. A 1 and a 1, well, go to the right, and go to the right again. So down here for a second visit, and then that's the 1, 1. 0, 1 will go to the left, and then to the right. So visit this one again, and then first visit here at 0, 1. And then 1, 0, visit here again, and then 1, 0, I'm going to go this way. 0, 0 will be a visit here, and then a new node out here. A 101 is 1, 0, 1. A 0, 1, 1 is going to be 0, 1. Did I say 0, 1, 1? Yeah. And out to 1. A 0, 0, 1 is 0, 0, and then 1. And then a 1, 1, 1 is 1, 1. Well, I guess we've been here already. Second one, and another 1. Okay, so this is, we've just represented as a tree some of the data. And you can imagine actually filling out this tree when we get lots of data that we're representing this way. Okay. So this is the idea, that if we had a lot of repeats in the data, so if we had a lot of white space in the graphic, then this tree is going to look really sparse. Okay, so if you had lots of 1s, for example, you're just kind of continuing down one branch of the tree. And if the data is pretty well random, then the tree is going to be very dense. Okay? So in information theory, you can actually measure the ratio of the sparseness to denseness and get a sense of how much compression you're actually going to get. So you can calculate what's known as a compression ratio. Okay? So, and if you've got something that you're using WinZip for that's got a lot of white space, then you're going to get good compression. If you hit it with something that doesn't have a lot of repeats in it, you're not going to get good compression. It's exactly what's going on here. Okay, so this is kind of where we come in. Suppose it's the situation that, let's say we've got multiple visits here, and suppose that we've got let's say 10 visits going this way and only 2 visits right here, given that we're at this point. Okay. That's the sort of scenario I want to think of. And the next thing, I actually want to apply this. And instead of looking at graphics or sound files or whatever, the logical thing to think of is representing these 0s and 1s as what? Ups and downs, yeah, like just what's happening in the market. Okay, so basically the idea that Armand and I pursued was to put together. We took FX data, we looked at it in terms of 0s and 1s, and asked the question, can we compress that? If we could compress, then it means that there is some predictability, some repeats. Okay, and this is an incredibly elegant way to do it. It's very non-parametric, very little structure to it. And basically, what we wanted to do was, if we were at this node right here, and if we saw that 10 times we went to a 1 versus only twice going to a 2, then that could be potentially valuable information for trading. Okay, so that's where this basically started. So we take the high frequency data, and we actually, this is called entropy coding, and there's a paper that's on the CD that's under this, under lecture number 11, where the theory is outlined for this. Basically taking the data, putting it through, and seeing if there is any predictability in this fashion. Okay. So that's the first thing we did. We wrote a paper for a conference in Zurich. And the people sponsoring the conference actually were vendors of this high frequency data. And they actually gave us 6 months of of Reuters feed to do that. And that was a big deal in 1995 to have access to data like that. So the paper was presented by my co-author, Armand Glajo. And basically, after it was presented, we were approached by a number of different people that were willing to fund the R&D for this method. And we decided upon one particular investor. And I guess we set up with Scott and Nate, I guess in Durham, to do the R&D, which took about a year. Yeah, about a year to develop. And then one day, this offshore investor's jet shows up at RDU, and we moved everything to offshore and began actually trading for this large investor. And then we did that for, I guess, 2 years or 2.5 years? 2.5 years, and then basically after that, we've gone on our own. So we've taken basically a year and a half to code up new systems. And indeed, what I'm showing you here is just like a basic idea. There's two critical components to what we do. The first component is kind of the logic of the systems. The second component is our view of time. That we don't use wall clock. So most trading systems use like 10-minute intervals or half-hour intervals. We've got our own proprietary view of when to sample the data, and it has nothing to do with wall clock. And what it does is it makes our systems very difficult to copy. It's one of the advantages. So so we've struck out on our own and struck off, not out, and we've got, I guess, two hedge funds operating. And Scott, do you want to pull up? Yeah, and show you some of the interface that we. Yeah, hopefully if it's turned on. Laptop. It's going to be hard to see, I think.
Yeah, this is we would our servers operate completely on the internet, and our traders would connect to the offshore servers to view.
So our main, our computers are offshore. That's important because we're offshore hedge fund.
But as Cam pointed out, some of the ups and downs in the market can be encoded into the forecast models. Here, for instance, are some forecasts on different time horizons on some bond and crude futures that are traded in Chicago, New York. And I'm not going to go into details here, but different price levels and different. I don't know if you can see anything anyway.
Yeah, it's pretty hard to see. I think you'd have to say what actually is happening.
Well, I don't want to go into too much detail about our positions here, but we do have a euro position and a crude position.
Yeah, so DAX up at the top, which I guess is pretty well almost
we
finished.
trade a couple of different futures markets in Europe and the FX, Euro FX, and some futures markets in the States. Right now, we're pretty quiet. Short position.
Right. So one thing that we've got the ability to do because of all our automation is to show in real time what the NAV of the fund is, and we're hooked into a site. One of the sites that we're hooked into is called plusfunds.com. It's an offshore site in I guess they're based in Bermuda.
All of the plus funds are actually BVI funds, British Virgin Island funds. They trade shares on the Bermuda stock exchange.
Okay, got it.
A secondary market.
Right. And this site is just amazingly cool because all of the funds that are listed with plus funds when you get in have got the ability to show in real time how their NAV is changing. So you can actually we shouldn't go to this site, okay? Yeah. Now, the reason we can't is because of its offshore status. But but it is a very cool site. It's one of the disadvantages of doing the webcast, I guess, that can't show you that. But I can privately show you in my office, and you see, the NAVs of these funds changing, like in real time. And to me, that is like kind of the future of this, to see what's happening, in real time. It gives like an extraordinary amount of transparency. Indeed, what we do, we are day traders. So we're out of the market at the end of the day. So the major asset that we've got is cash. Like we can sleep in the evening. We're not carrying any positions. Okay, and a lot of the time we are actually just simply in cash. Yes.
When you say that you can show the real-time values of these funds, does that mean that they're only holding highly liquid funds and not?
Exactly. Yeah. For ours, especially everything that we're holding is highly liquid, and we know, we've got our own systems where we can. Yeah, Scott.
There are funds who have illiquid assets, and there are different ways that they can value those assets. And plus funds in particular will indicate to the investors what percentage of the manager's assets are liquid, third-party priced assets, and what may be, say, real estate holdings or something. And you can see if a fund is 0% manager marked assets, it's all priced, Reuters priced liquid asset futures or stocks. And if it's 100%, then it may not be. So that's something that would be transparent. But it's still close.
But for what we do, it's in real time. You see exactly what we're doing. The markets are incredibly liquid. We trade with the following strategy in terms of the amount of margin that we use. I guess currently we're trading T16? Yeah, T16, which is basically means that our margin to equity ratio is 16%. Okay, so what does that mean? It means that the maximum possible exposure we could have would be 16% of our assets under management in the futures market on maximum margin. Okay, so if we've got basically like $100,000 under management, then 16% or $16,000 could be allocated to margin for a particular commodity. Okay, so that's the maximum exposure that we would have. The average exposure that we would have would be far less than that. So we're in the market. We could be in the market in a levered way, but not very levered. Okay, 16% is pretty small, and we're out of the market at the end of the day. So it's extremely attractive for a lot of people that are worried about hedge funds carrying potentially very risky positions overnight or for many weeks. We're out. And we've got the usual sort of stop loss type of things that kick in if a market goes against us. It's completely systems based. So our traders execute what the systems tell them to do. Okay, completely automatic. And traders are scattered all over the place and all hooked up via the infrastructure that we've created. It's very, very cool. In terms of how does this actually perform? Yes, Louise.
You mentioned earlier that your system has a particular view of time. Could you explain what this means?
No, I can't actually. It's the one thing I can't really explain. Yeah, so just think of it as the traditional wall clock view of time is that you sample by certain intervals in time. So if you actually look at the academic literature or see what the practitioners are pushing, it's often you take certain intervals. So with high frequency data, it might be that you sample every 2 minutes.
So that's when you make your decisions.
Yes, exactly. Or the data that goes into your program is based upon 2-minute samples of the prices. So you calculate, let's say, returns every 2 minutes, and then try to forecast that. So you're forecasting over the next 2-minute interval. That's not what we do. because there's no rigid sampling like that. But but we really couldn't reveal the exact nature of how we sample. Yes.
So can you be set up essentially to flexibly data snoop, if you will? I mean, you take that string of ones and zeros and you start looking for patterns. You can go back a certain length or a certain other length, and you can snoop the data to see which give you the best forecast going forward, and then selectively. So you can build a lot of flexibility into how far you go back or what forecasting you use, right?
Yes, it's like how much data do you use to build a tree? How do you know when there's too much, when you want to like replenish the tree and start anew. Indeed, I've sketched only the rudimentary details of it. This is not data snooping in the traditional sense that maybe we were doing for assignment 2 and assignment 3 and assignment 4, where you're trying to yank down some variables to predict the return. This is a structure that's set up. It's not using any side information. It's not using any conditioning information. It's simply using what's actually evolved in the market, okay? But in a very cool way. But you're right, there's kind of another level to it, like how much data do we use for a tree? How many trees? We have multiple trees going on at the same time potentially, right? So how do you decide, how do you weight amongst the trees? And there's all sorts of other stuff, like I showed you that example where you go to the right 10 times, to the left twice. But if one of those in the left is like a minus 20%, maybe I should get some weight. So you could actually calculate, if you go to the right 10 times, you calculate what the average return was. You go to the left twice, calculate what the average return. So you can actually put information like that in there. And there is a theory that goes beyond this, where instead of just having a simple binary tree, that you can have much more complexity to this, incorporating what's happening in other markets, site information, all sorts of stuff like that. This is like a simple implementation. It's the rudimentary stuff. But you're right. There's always the risk of data snooping, and we have to be very careful in terms of validation. And indeed, the research protocol that was kind of the first thing that you did in this course, that was the first thing that we did, was to develop a research protocol and kind of like live to it. Because we realized that if you strayed from that, then you're going to go down the route of data snooping. So it's quite rigorous. Yes?
In the tree, you said you have different view of time. But as I see it, you're actually losing all the information about time unless you have a way of tracking when a node was visited. Question is, do you keep that information of time, as the node was visited, or you just course in the
remember
frequency data?
when I showed you that string of zeros and ones, that is going to be a function of how you sample the data. So if they're returns. So they could be like 2-minute intervals, and I get a string of zeros and ones. Or it could be our proprietary slicing in time. And that's the raw materials that we work with. Yes?
Go ahead on Prakash's question. I mean, how do you know whether you go first left or first right? I don't see.
How do you start it?
From the
Yeah,
order.
it's actually an issue. Where do you start? And I guess the way that we addressed it was that we've got multiple starting points. We have multiple trees operating. You can think of it that way. And what you need to manage is which trees are performing the best and which ones are performing the worst. So you can think of a second level of control in this idea. And this is just a sketch of 100,000 lines of code, I think.
Oh, that's nothing. I mean, we pride ourselves on less code rather than more
Yeah.
code.
So it's pretty complex, and I guess it is not a black box because I can explain the basic stuff if I could speak freely. But it's pretty rigorous and very difficult to replicate. Very difficult to copy. Indeed, the traders, once they think they've figured out kind of how our system works, we surprise them. So it's very difficult to predict. In terms of, I wanted to show you one of the performance sheets. This is system performance, and this is a T16 that I wanted to show you a little bit. It's going to be hard to see, but this includes both some back testing plus some real time. I'm going to zoom big time on this. So this is through 2000. So it includes, as I say, some back testing in 93, 94. In 95 includes some time where where things are actually running, and then it includes the new systems that we've developed over 98 and 1999 through 2000. The very top line is the annual return. And then below that is the fee-adjusted return. We're operating on low risk. So because we've only been going like a year to get things going, because we didn't have that many commodities actually trading, we decided to turn the risk down. And that's why we're going T16 rather than T32. And you can see this actually in the volatility, where the volatility that we ran in 2000 was 8.8%. On an annualized basis. So pretty low volatility, and systems delivered 22.3%. It's completely uncorrelated with sort of known benchmarks. And that, indeed, that was one of the things that we actually have done for investors. They said, well, can this be mimicked by any known style like momentum or stuff like that? And when we kind of fed our returns into these style analyzers, you get no correlation. There's no correlation with any known benchmark, and the performance of the systems is pretty impressive. So on average, days profitable are over 70%, and the maximum negative month, even within all the simulated data, for this particular implementation is I think it's minus 4.51%, which is, you look at what happened yesterday in the NASDAQ, basically, and you see, huge volatility. This is a low volatility situation and pretty robust. So that's kind of like, what I do in my spare time. And in terms of kind of like the macro view of this, if you've got something in terms of a trading system, it makes the most sense to set up an international or offshore hedge fund. Like, that's the way you're actually going to get rewarded for this. You get directly a piece of the upside. And you can charge, significant management fees also. So kind of the way that I see it is that if you've really got something, then that's where you actually go. It's not that you're, if you can become a mutual fund manager, but the upside is simply not there. So that's kind of perhaps a way that you can explain the performance of mutual funds, and with all deference to the webcast students from the mutual funds. But you can run the numbers, okay? And on average, actually the webcast students watching from Vanguard and Fidelity are kind of the leaders. But if you look overall at mutual fund managers, the performance is not that impressive. Okay? If you look overall at the hedge fund managers, it's a different story. The real question is, what sort of risk are they taking? Okay, so there could be extreme risk in some of their positions. Okay, and there's many different types of hedge funds. So it could be that they've got a bet on, like LTCM did, with 100 times leverage, right? And it could go the wrong way. But this particular style that we're pursuing is a style that's got minimal risk. You're in and out of the market the same day. The leverage that you're employing is minimal. the maximum leverage that you could have. Depends upon the commodity mixture, but it's quite manageable. Okay. Yet you're able to generate returns. And the amazing thing to me is think about the markets that we're playing in. U.S. Treasury bond futures, perhaps the most efficient market in the world. Okay. Treasury bond futures. That is real hard to go against. Yet we've got systems that consistently make money on T-bond futures. We're trading the euro. It was a bit tricky in getting that one up because all our historical analysis was on other currencies like the Deutschmark. But basically, we just applied the Deutschmark system to the euro. It seems to be working fine. So crude oil, things like that. These are very informationally efficient markets. Yet, if you've got an idea, you can actually go in and come out of it with some profitability, which maybe is, for me, as an academic a number of years ago, I wouldn't believe that. But now I do.
But there's size limitations to that?
Yeah, absolutely. There's size limitations. So if you get too big, it's going to be a real problem. So we go in, and if you start going in with 500 or 1,000 T-bond contracts per leg, per trading signal, that's going to move the market. Okay, that's a part of your transactions costs. So there is a real disadvantage of being too big because you can't do what we're doing. So we have to be kind of a medium size. However, we can actually, the currency market, like the euro market, that's pretty deep. With the amount of currency transactions, cash currency transactions, you could take a lot of size right there. And I guess the one exciting thing that we're pursuing is we think that the same systems ideas that we've applied to futures and to cash currencies could be applied to equities, like high volume equities. So we grabbed some data on certain high volume NASDAQ stocks, and right now we're trying to calibrate some systems. And when you go into equities, again, you can be even larger. So size is definitely an issue. Right now it's not an issue for us, but it could be if this continues to work. Yes?
Do you have an economic explanation? I mean, for some of the various markets you talked about, the T-bonds or oil or anything you can attribute it to?
Yeah, that's a standard question. It's an excellent one. Why? How is it that we can make money on the Treasury bond futures given that it's the most efficient market in the world? And the way that I kind of think about how our system works is that it's basically an incredibly powerful technique and with very little structure and a lot of flexibility to identify patterns. And perhaps the best way to think about what we do is we're not taking bets on announcements. Indeed, we'll be out of the market if we know there's an announcement coming. Okay? But we come into the market after the announcement. And perhaps one way to think about how we make money is that we've got this catalog of all the different kind of responses to information. And we can kind of see what's happening as a response to the information, and then our system kind of kicks in and says, well, that's familiar, and we're going to follow that. So it's kind of like the response to the information that we're capturing. In terms of market efficiency, what does that mean? Well, in an efficient market, an announcement's made, and you just move to the new price, and that's it. Okay, but we know the markets, and even the T-bond futures market, not like that. It takes a while to adjust to the information. Even though it's pretty fast and we measure it, in terms of a small period of time, it could overshoot, it could undershoot, it could oscillate on the way back. There's many different possibilities for how that information feeds its way into the market. And that's what we capture. Okay. Any other questions on my moonlighting? Okay, good. Well, let's take a break down. Thank you, Scott and Nate, for coming in.
Most of it. Thank you.
Oh, it does. He was saying for.
Okay, let's get started again. I wanted to talk just briefly about assignment number 4, because I know some of you elected not to do that assignment. So I wanted to kind of communicate the main idea in that assignment. And I guess in my experience in asset management, I've noticed that currency is kind of like an afterthought. So in global asset allocation, kind of like set your portfolio. And then it's often the case that you kind of farm out the hedging function to somebody else, somebody who's a real expert in FX. So it's a non-integrated type of management. And what I wanted to force you to do in assignment number 4 is to think about the integration of Forex within the global asset allocation problem. So that was kind of like the idea. So indeed, the very last question of assignment number 3 asked you to think about this before I actually took you through the process. And people were saying stuff like, maybe we want to hedge. And then they weren't that specific as to how to actually hedge. But in assignment 4, you actually have to do that. Oh, the other thing, before I forget, I did post to the iDrive the performance of the prediction models for assignment number 3. That's available. I forget what the file's called. It's a short Excel sheet that I put together last week. So that's there for you to see. So the basic idea is, what I wanted you to think about in assignment number 4 was, what does it mean to hedge? So, as I say, it's so common to see, okay, here's our allocation, and let's make sure we hedge all the currency risk away. Okay, and that's usually implemented a number of different ways. The most common way is if we're investing, $100 million in the UK, then you basically execute a forward transaction and sell the principal. The $100 million, whatever it is, translated into pounds. Sell the principal forward at some point. So one thing that we need to think about is whether that's going to be effective. And it turns out that if you've got a 1-month horizon, you don't know what the value of the portfolio in the UK is going to be at the end of the month. So you sold $100 million. Well, actually, you're selling the pounds, whatever that translates into. But you don't know if the market is actually going to be there. Actually, you do. If the market return is 0 exactly, then you've done the right thing. But if the market's gone up, then you've got more pounds to sell than you actually hedged. And if the market goes down, then you've got a hedge that is selling more than you've got. Okay, so the question is, how much do you actually hedge? Is it the principal? Some people suggest that the principal plus the expected return is not a bad idea from a forecasting model. But no matter what, there's going to be variance. You're not going to exactly hit. So the first thing to realize is that there's no such thing as a perfect FX hedge. Okay? To get that assumes that you have the ability to do 100% forecast what the equity market's going to do. Okay? And that makes it problematic to look at local currency returns. Okay, so a local currency return, you're not going to be able to obtain. And what is the scenario where you can obtain the local currency return in that stock market? It's really hard to think through. People say, well, maybe you can get close to it with dynamic futures, rebalancing, stuff like that. It's just not clear to me. I told you to work in US dollar returns because those returns are obtainable. Those are simple returns. You take your money, translate it into pounds, buy the UK equity market At the end of the month, you sell the UK equity market, and whatever the going rate is, you translate back into US dollars. Okay, or you just mark to market without actually doing all these transactions. When you mark to market, it's simply whatever the value of the UK market is worth, translated at the going rate at the end of the month into US dollars. Simple. So US dollar returns are obtainable. Local currency returns, that's not obvious. Okay, so it's kind of like a couple of things going on here. One is, how do we actually execute the hedge? Number two is kind of thinking about what a local currency return is versus a US dollar return. Okay. And the third point of the assignment, aside from doing the prediction models and the beta changing through time, was to get you to think about what hedging really means. We think the usual sort of procedure, as I said, is that you set your portfolio, then you hedge the currency. But is that optimal? Is that what you want to do? Does that make any sense whatsoever? And if we think about it in terms of mean variance, what you're doing is you're setting weights arbitrarily. And anytime you set weights arbitrarily, you're going to be inside the efficient set. So I guess the goal of that assignment was for you to think of currency as an asset. And that's why there was some question on, and I had some people in my office asking questions about this, the currency return versus the change in the value of the currency. Okay, those are different things. Okay, so if I take $100 million and translate that into Swiss francs, okay, and then hold that for 1 month, the return that I'm going to get when I translate those Swiss francs back into US dollars is not just the change in the dollar Swiss franc rate. Because I've taken those Swiss francs and I'm not stuffing my mattress with them. I'm not just holding the cash. That doesn't make any sense. It's a crazy thing to do. You take them and put them into a Euro Swiss franc account. You'd earn some interest. You never let cash lie around. So the change in the exchange rate is not a return. It's a return to a strategy that nobody follows, and that's just to hold the cash in a mattress. So that's why I wanted you to calculate currency returns that included a euro deposit rate, because that's what you would actually do. And then, instead of going 100% hedge or no hedge, so you could think of trying to obtain the local currency return as like a 100% type of hedge, and to obtain the US dollar return is no hedge, is zero hedge. Right? Take whatever the exchange rate is, don't do anything. And that's how we operated in assignment number 2 and assignment number 3. Assignment number 4 says, well, these currencies are just assets, and they might have interesting covariances with the underlying equities. Kind of makes sense that what happens in the currency market could impact your equities? Yeah? Absolutely. So let's use that information. Use that information, feed it into the optimizer, and let the optimizer figure out what is optimal. And it's the case that with zero probability that you're going to get the 100% hedge. Well, I guess there's a fraction over zero. There is a chance, but it would be such a long shot. So what you're going to get, and those that actually did this, you might actually get the reverse of a hedge. So instead of selling euros, you're buying euros. So it's so-called doubling up. But that's optimal for your portfolio. Because of the covariances and correlations, the expected returns on the currencies, the volatility, when you mix it all together, it's not obvious that, well, one thing is definitely obvious. You don't do the 100% hedge. Yes?
Well,
say you set up your optimization model and you get close to zero weighting for UK.
Oh, UK what? UK equity?
For UK equity.
Yes.
But then you get some weighting, either positive or negative in the currency.
Yes.
In essence, you're not really hedging, you're speculating, aren't you? Because you're just playing the currency
What are
market.
we trying to do in this exercise?
The equity market, without the equity market.
What are we trying to do in our global asset allocation exercise? We're trying to maximize the expected return for some level of volatility.
Right.
So given that we've got positive volatility, you could say that we're speculating. Right?
Right.
Okay, so what I wanted to break the way that you think about currency hedging. That was the goal of this. So I'm very comfortable being in a situation where I've got a zero weight in UK equity, but I've got a non-zero weight in the currency return.
So
That's
right,
fine.
just thinking about it as asset class X and asset class
Exactly.
Y.
We've got equity, we've got bonds, we've got Forex. It's just an asset class. You know, and if it's an asset class, it needs to be integrated into our asset management model. It's not the situation where we figure out what our weights are, and given that we've got a zero weight on the UK, then we tell our currency manager, don't do anything with the UK.
Cam,
Yes.
are you achieving the kind of hedging just by virtue of the fact that you have a diversified portfolio, but it doesn't have the same linkage between currency and futures as you have when you're actually in the hedge portfolio, where you're actually hedging in currencies in which you're invested in equities?
Okay, run the question again. I'm not sure I understood it.
Back to the assignment number 4. In the first
Yes.
part, we actually hedge by using forwards as opposed
Correct.
to the actual spot rate at the end of the month. Whereas in what you just said is, regarding Ray's question, you're saying that I'm even though I'm not investing both in currencies and equities, I achieve some kind of a hedge. And I'm saying that hedge is just on
okay,
the
but
basis.
maybe I didn't say achieve some kind of hedge. I'm just saying this is my investment portfolio. For some level of volatility, I'm going to choose the weights that deliver the highest expected return. And it might be that I'm doing some currencies in countries where I'm not in the equity market. And I
Right,
just,
but you can achieve the same thing without even investing in currencies, just having a diversified portfolio, right?
but what we're trying to do is to deliver in an optimal way the weights that define that diversified portfolio. That's what we're doing. Okay, that's what we're trying to achieve. You're right, a diversified portfolio, and just basically use the information in the covariances and the volatilities, the expected returns, come up with this diversified portfolio at some level of variance that we're comfortable with, and see what it says for the currencies. Okay, and we've got to be careful because it might be that it says short like minus 500 weight on the pound, right? And we're not going to do that because that would be probably beyond the tolerance of our mandate. But I have no problem. Just consider it an asset class. We've got equities, we've got currency, and then we can take a bit. Now, somebody might say, well, you're speculating in currencies. Well, but you're speculating equities also. Right? So, what's the big deal? Okay, so that's, now let me tell you that the story that I'm telling is a difficult story to sell. Because people are just so used to thinking of, well, let's just hedge the FX risk, okay? Or they'll say, well, we're not good at forecasting what's going to happen in terms of currency, so let's just get rid of that risk. Okay. Now, what's wrong with that argument? So people say, well, it's not our game. We are equity pickers, and here's our portfolios. We can do really, we don't have expertise in Forex, so let's just 100% hedge it out. Yes?
I mean, isn't it difficult to hedge away risk if you're holding an equity in a foreign country and trying to lay off all foreign currency risk? You're assuming your time periods are going to match up perfectly. Right. It just seems like.
Suppose we could do that. So let's suppose that we could lay off the currency risk. So that there was the ability to do that. What I'm trying to get at is, is there a flaw in this argument? I guess you can tell there is. That I don't know, I'm not very good at forecasting the expected returns in currency. Let's just get rid of it and focus on the equity because I don't want to be playing this speculative game in currency that might really hurt my equity performance, right? So if I do the double up reverse hedge, that could kill my equity performance. I don't want that. I just want to focus on equities. Yes?
You can hedge away 100% because equity return, you can forecast equity.
That's true, but I'm just saying, suppose in my example that there was some ability to do that. Okay, so, or 99%.
It's just like first question of assignment 4. I mean, you can, even you sell $100 million forward, you still
Right.
can hedge it.
Like I agree that you cannot 100% hedge it, but let's say that we can get rid of a lot of it. Given that we're not in the game of forecasting Forex, should that mean that we don't do what assignment number 4 suggests? Yes?
When we're using the unhedged expected return in the optimizer, that does include both the return on the asset class itself and on the currency position.
That's correct.
So you can't use that to optimize.
Well, you could use the, and we did, in assignment number 2 and assignment number 3. We simply said, well, these are, here's 5 countries. It's when I'm going to invest in the equity markets. I'm not going to worry about currency. Whatever happens, happens. And these weights define the best portfolio for some level of volatility. That's it. It's simple. I guess what we're thinking in assignment number 4 is, well, let's expand our number of asset classes. Think of it simply like that. So we have the US and 4 different countries. Now we're going to add 4 different currency portfolios. So we're going to have 9. So we've got 5 equity markets, and we've got 4 Forex markets, Forex returns. And see what happens, adding these new classes. Okay? But the real question is, what if you realize that your prediction model for currency's got a 0 R squared? And will always have a 0 R squared. Does that mean that you just decide to do what we did in assignment 2 and 3? Look at the 5 equities? Or should you also go forward with assignment number 4 and add these to your allocation?
The hedged returns are not asset classes separate from the unhedged ones.
Well, remember, all we've got is US dollar returns, which are unhedged. And then we're adding some currency returns. The weights on the currency returns are going to determine the so-called hedge. And whether it's even a hedge in traditional sense. So you've got a 0 R squared. Yes?
Well, I kind of think that if you're hedging, you're actually in a sense taking a position on the currency anyway, and you're not factoring the mean variance, so you can be better off, just treating them as separate asset classes. By hedging, you're just taking a bet on it.
Yeah, so you're saying that if we just step back and take whatever happens, it's kind of like a position, you got a view on what's going to happen in the currency. Yeah, that's an interesting argument. Yeah, I think there's some merit to that. But if you really had a view, wouldn't you want to put the currencies in to your asset allocation directly?
Right, exactly. That's what I'm saying. So by hedging, you're already saying that you have a view, so you're better off just putting a view.
But suppose you don't have a view. They're a nuisance. And you see all these people get burned doing currency trading. They're taking macro bets on currency. So the question is, should we have 9 assets or 5? If we realize we have no predictability in the currencies. We don't have any models, and we have no intention of hiring the Fuqua MBA to develop the model for us. Okay, so that's it. We have a 0 R squared. So should we do 9 or should we do 5? Yes?
Even though we may not have any predictability on Forex, we should still do 9 because there's still the ability to diversify the idiosyncratic risk of the Forex against the broader markets.
Okay, and I think that's maybe when people were talking about diversified portfolio, this is very much related. Yeah, we might not be able to predict the return, but the correlation is going to be really important. And we need to use that correlation. So there's no problem in putting in a 0 R squared asset into our kind of optimizer, because we hope that at least the correlation is somewhat predictable, and the volatility is predictable, and we're going to use that. So again, you put it in as 9 assets, and then you take a look to see what it's suggesting. So it's using all the correlations. It's figuring out, given the correlations. You know, there's an extreme example. It used to be, well, even today. You know, what if you had a position where you had like a quarter of your portfolio in German equities, and you had a quarter of your portfolio in Swiss equities. German equities long, Swiss equities short. Doesn't make any sense to go lay off the FX risk on the German equity and on the Swiss equity. Does that make any sense? And why doesn't it make sense?
Correlation.
The correlation between the euro and the Swiss franc is pretty substantial. And that's ignored. It's almost offsetting in this particular example. So again, you know, this is why it's important to actually put this stuff together and let the program give you some indication of what you should be doing. And it might not be 100%, it might be like 10% that you actually do. So use the program, use the correlations to figure out what sort of optimal portfolio should be. Okay. So is that clear? So basically what my goal here is for you to think about, and we have to talk about Forex a bit because this is like a global asset management course. But I think that Forex is just an asset class. That's what I think. And indeed, it is very difficult to forecast at kind of a long horizon level. At a short horizon level, that's a different story. There's tons of people that forecast the direction of Forex. Indeed, one of the best assets to all these systems traders in terms of Forex is the actions of government. The government induces predictability. Okay, at least at the high frequency basis. So, so high frequency, there's some predictability, and there are these people that make macro bets on currencies that tend to do just fine. But I'm not sure if that's luck or skill. It's real hard to determine. Yes.
Do you recommend on like a global asset thing, kind of break it into pods and say we're going to bet on Europe and put a 30% allocation there, and then because when you're in Europe and you're making that commitment, you might move it around inter-Europe and you don't have that currency play on a monthly basis, which assignment 4 asked us to do. Kind of, we're forced to repatriate it all the time.
Oh, that just means marking to market. That's all. You don't need to repatriate all the time. I just phrased it like that. Just so you think about the actual transaction that would occur if you did repatriate. But it doesn't really matter. If you're marking to market, then it's effectively the same return, except you don't bear the transaction's costs. Okay. So is that? I know it's a different way to think about this stuff, and as I said, this is somewhat difficult to sell because people think of hedging, whereas I'm just thinking of not hedging. It's not clear what the logic is for the Forex hedging in terms of global asset allocation. But what are we trying to hedge here? Like, think about it. What are we trying to hedge? We're trying to hedge. We're trying to figure out the portfolio that delivers the highest expected return for some level of volatility. I don't want to set some arbitrary constraints in terms of achieving that. And Forex is just an asset. So give it play like any other asset. It's simple if you really think it through in terms of global asset allocation. But as I said, there's a lot of resistance because people, well, we don't want to speculate in currencies. Yes?
If you're a corporation selling goods overseas and maybe you sell in a country that hedging or using a foreign exchange instrument isn't quite as easy, are there other sort of proxies that corporations can use instead of?
Oh, sure, yeah. if the market is not that liquid, and first you should realize that there is a market for every currency in the world, okay? It's just that the cost of transacting is incredibly high. So we could phone our friendly investment bank and we can get a quote on whatever currency you want, except the cost of trading is going to be enormous in some of these markets. So what do you do? Well, a corporation, and this is different because a corporation might choose to lay off the currency risk. And there's a reason for actually doing that. Because it wants to focus on what it does best, and it actually wants the financial flexibility to pursue positive NPV projects. Okay? And this is a different situation than our global investor. Okay? Because there's real costs to raising money for the corporation, in terms of issuing equity, issuing bonds. Those are very costly to do. Okay? It's not like we have a pot of money and we're trying to allocate it to get the highest expected return for some level of volatility. So a corporation might choose to do that, to lay off that particular type of risk. It might choose to diversify its operations internationally to reduce its volatility in order to provide some stability to cash flow so it could seize the positive NPV project. So how do you do this in some countries that it's very difficult to trade in the currency? Well, one thing that people often do is they will actually go into that market and to some extent try to borrow in local currency. So they will actually, their capital structure will change to take certain hedging opportunities into account. It's also possible to construct portfolios of other currencies that are more liquid, that correlate with the currency you're trying to hedge, and try to do a hedge that way, but that's not going to be perfect, obviously. Nor borrowing in that particular market is that going to be perfect. You have to do what you can. Okay, so that's kind of like assignment number 4, and I've got like 25 minutes to kind of get that time to tell you kind of like my view of where we've been and what I hope you've absorbed. Okay, there's this video that's available called kind of like course conclusions. I recommend you take a look at that also. And that's a good way to kind of review. Let me kind of give my helicopter tour 25 minutes in terms of the global asset management, the way that I see it. And I want to emphasize the sort of things that we haven't really figured out yet. Okay. So we started this course with this view of potentially 4 different levels of asset allocation. And we kind of review those and then kind of weave through them. So the first one you recollect was simply the benchmark. Okay, so if your benchmark's the S&P 500, you buy the S&P 500. It's done. Okay? And I emphasize that that is not as trivial as it sounds. You need a lot of mechanism to actually get that right, but it is mechanical. Second level of asset allocation is strategic asset allocation. And this is where we take a longer term deviation from the benchmark. So a longer term bet, because we think that a certain asset class is going to outperform or underperform in kind of like the 2 to 5 year type of horizon. Because that's strategic. And we showed that we could actually build a model to do kind of long horizon forecasting. So I gave you that data. Don't redistribute that data. It took a long time to put together. From 1876, monthly data. Okay? And we used that data to develop a model. And actually, when we did this in assignment number 2, we kind of found that we learned something about regression-based forecasting. Because just by looking at the results, it suggested that we had a really good model for the S&P 500 using the dividend yield. But on closer inspection, we're kind of in a very dangerous situation of forecasting outside of the data that we actually have. So that was a very important lesson. And we also got to think about these variables that could be useful for asset allocation, like the dividend yield, and why it might mean something different at one point in time versus another point in time. Okay, so we start thinking about predictability, and that's what strategic asset allocation is. It's kind of like longer horizon predictability. And people talk about mean reversion in returns. They're talking about kind of a strategic view, okay, that there will be a reversion to the sort of levels that you expect over the longer term. Okay, so that's strategic. We can build quantitative models. I've built quantitative models based upon kind of this short 2 years to kind of medium 5-year horizon. So that's the second level. The third level that we focused a lot of time on in assignment 3 and assignment 4 is the tactical exercise. And this course used to be called Global Tactical Asset Allocation. You probably saw that a few spots in the HTML notes. And that's all we did. It used to be that's all we did. Build forecasting models and see if we can use those in asset allocation. So here, these are monthly or quarterly models that are forecasting one period ahead, trying to do better than a buy and hold strategy. Okay? And actually, we had some success in assignment number 3, though modest success. And indeed, you know, when I put my list together, I noticed that a lot of the variables that I used in my papers, I don't see them in a lot of these models. And I think that these models provided the base case, but there's a lot of predictability that we didn't uncover. And look, you had, what, like a week and a half to do assignment number 3? A week and a half, and you're juggling many other courses at the same time. Now, if you had full time devoted to that exercise, it would have been a different story. So there's a limited amount that you can do, even if you work all night, for assignment 3 and assignment number 4. Okay, but what you can get done in a short period of time is potentially quite impressive. And I did see some models with hit rates that were, you know, like 73% on a monthly basis, and that's pretty impressive. And I also saw some models forecasting markets that I didn't think were predictable. In Germany is very difficult to predict, and there were a couple of models that looked pretty good for Germany. So on a tactical basis, you know, there's money that we can make incorporating these forecasts. We talked about volatility and correlation, Garch kind of modeling, and for volatility. For correlation, we're basically using the historicals because we have implementation problems with looking at a multivariate Garch kind of framework. So tactical, very short-term oriented. We're taking bets from the strategic asset allocation weights. Okay? So we've got our strategic view, and then we've got a tactical view. The way that we implement tactical often is with futures contracts. Because tactical induces a lot of trading costs. We want to minimize those trading costs by overweighting or underweighting on a short-term basis based upon futures contracts. And the last part to this was kind of some of the stuff that we talked about today. That traditionally asset management has been, you know, a quarterly exercise or a monthly exercise. But now, with the ability to run really high power computer programs, artificial intelligence-like programs, and remember we did in the second lecture, I showed you the speed and the ability of computers is catching up to where we are very, very quickly in terms of the brain. The neural nets that have been implemented in practice are so trivial that there's no surprise that they don't work. But with complexity, like we talked about today, in terms of using information theory to try to come up with a very non-parametric way to represent the data, and a very elegant way to recognize patterns that might repeat in the data and have probability assessments as to when they will repeat. That stuff, you know, while we have maybe an edge right now, there's other people working on different techniques. And maybe it's not wavelets, as we saw in the Lehman case, but there's other stuff out there. Okay? In the future, I said in the second lecture that the future that I see is computer battling computer. Right? And the Forex market's a great market because it's so liquid. And that's why I really believe in something like Forexter, because it's going to enable that sort of thing to happen. The transactions costs will be cut dramatically. But kind of underlying all of this is just the system, okay? A high frequency trading system. And those systems will be doing battle in the future. That's the way I see it. Okay, and once your system's actually going, and maybe it's good to be first in, but once these systems start taking the information, learning and learning and learning, you would think that this predictability is going to diminish. And we talked about that in terms of our view of efficient markets, and that's another really important thing for this course. So yeah, I am the Chicago graduate, the student of Eugene F. Fama, the person that coined the concept, efficient market hypothesis, 1970 American Economic Review article. I know the words. You have to memorize them in terms of the definition. Because if you got it wrong on the preliminary examination for your doctorate, that was a really bad mistake. Okay? So I know the words. And also, I think I've got an understanding of what it really means. And people that don't know much about efficient market theory, will say, well, you're from Chicago, therefore you believe in efficient markets. Anybody who says that or makes a joke about it, oh, Chicago, efficient markets theory, that just means to me, it's screaming at me that this person doesn't understand the notion of market efficiency. Okay? And it is really stark that markets are not efficient. There's no market that's efficient, because efficiency means the price is instantly and accurately incorporated into the information. So announcement we talked about today, announcements made. T-bond futures, on the next tick, go to exactly where they're supposed to go, and that's it. That just doesn't happen. That doesn't happen anywhere. Okay? Even the most efficient market. And the T-bond futures market, that's got to be one of the most efficient markets in the world. It's incredibly liquid. It's a futures market, so it's very low transactions costs. It's very difficult to move the market. Very difficult. Unless you come in with very large size trades. Okay, so that market, if you can learn by patterns in that market, then you just extrapolate to these other markets. The US market, the equity market, you would think is very efficient. But it's efficient only in a relative concept. And that's maybe the way to think about efficiency. Yes, the US market is way more efficient than the market in Peru. There's no question about it. But is it perfectly efficient? No. Okay, so when you've got information that's slow to be incorporated into security prices, there's going to be some degree of inefficiency. So that's the first thing. The second thing is that predictability in any asset return does not necessarily imply inefficiency. And that's one of the hardest things to kind of think through. And it's hard to think through because predictability could imply inefficiency. But it is possible to have some predictability in the asset price that's purely due to kind of evolving risk through time, or risk premium. So you look at the data, and you can see that the risk premium, to get people into the equity market, you have to offer a very high expected return in a recessionary time. And at the time of a great boom, the premia to get people into the market is a lot less. Okay, given that most of the time it's reasonably straightforward to figure out where you are in the business cycle, like there are certain points where we're not sure. Like right now, we're kind of not sure. Are we at the turning point? I think so. But we're not 100% sure. But last year, we were very sure where we were. So given that we've got some ability to kind of know where we are in the business cycle, given that we've got some ability to predict the direction of the business cycle, then that's going to kind of permeate through and give us some level of predictability in equity returns, both at the strategic horizon, mainly over shorter horizon, and at the very kind of like monthly or quarterly horizon. There's going to be some predictability. It's going to be implied by sort of theories that we consider reasonable. And what is a reasonable theory for us? A reasonable theory says that I'm going to be rewarded if I take a risky position. And that's really all we need. That's, you think, well, what is asset pricing theory? Well, asset pricing theory is simply a way to quantify what we're going to get if we take this risky position. So we're going to have to measure the risk somehow, and we're going to have to assign kind of a reward for the risk. And that's all asset pricing theory is. There's many different asset pricing theories, which means there's many different candidates for what risk actually is, and many different candidates for the reward to risk. But all of the theories are basically the same. It says, here's the risk, here's the reward, put them together, and I get kind of the expected premium that people are willing to pay to buy or sell this asset. Okay? That's all asset pricing theory is. The capital asset pricing model, we talked about it. It is incredibly simple model. One measure of risk and one risk premium. Beta is the risk, and kind of the reward on this diversified market portfolio is the premium. Very simple model, very elegant model. A lot of staying power. A model invented in 1964, still widespread use today. Even though there's a lot of alternatives out there with multiple factors, multiple risk premia, dynamic factors, dynamic risk premia, the simple CAPM, it lives on, even if it's challenged. It's got good intuition to it. Okay? And we can use these asset pricing theories to kind of put all this stuff together. Okay? So we can think of the asset pricing theory in terms of our predictability problem as we can think of predictability being partially induced by predictable changes in beta and predictable changes in premium. So once we specify an asset pricing model that's dynamic, changing risk and changing risk premium, then we can understand where some of the predictability is coming from. And then we kind of come to this part of the course that is maybe the most confusing. When we talk about explanatory models, predictive models, we talk about cross-sectional explanatory, cross-sectional predictive models. It's kind of a lot to sort out. And let me just kind of review that a little bit. The prediction model is a purely statistical model. We developed that in assignment 2 and assignment number 3. Take a return, regress on the past information. Get a forecast, you're done. Now, it might be after you look at these forecasts that you might want to tell a story about why the predictions are changing through time and link that story to changing risk and changing risk premium. But that's not what we've got. We've got a simple prediction model. Okay. And then there's this, what I call linear factor model. And that's different because we're explaining the return. So it's no big deal if IBM stock price goes up by 10% if the market that same day goes up by 10%. You think that IBM is drawn by the market. Okay, so a lot of the variation in the equity price can be explained with what's going on in the market or other factors contemporaneously. And we use this type of model to identify risk. Okay? We identified the elasticity. You can think of it that way. So what is the average sensitivity of IBM to a 10% move in the S&P 500? What am I expecting to happen? And you can think about measuring that through a beta. Or we could say we have a model with the market and the change in the oil price. So I said, well, what happens if the price of crude oil goes up by 10%? What is the average impact going to be holding the market constant for IBM? How much will the price of IBM go down by in percentage terms? Okay, so we can identify with this linear factor model various different sensitivities. And that's going to be useful for us. It's going to be useful for us in terms of risk control. And it's potentially going to be useful for us in terms of asset management. So remember I said that there was a way to use these explanatory models to actually do asset management. And that's where you take a position on what's going to happen to the factor. In a simple market model where you're regressing IBM on the market, then if you've got a view of the market, then that would lead to some strategy of market timing. And I think I described this where if you want to implement that, if you think the market's going to go up, you load up into high beta stocks. You think the market's going to go down, you put your money in low beta or negative beta stocks. That's called market timing. Okay? And you can extrapolate that to other factors also. So it is possible to use the explanatory models in this exercise of taking a view on the factors and actually implementing a strategy, a tactical strategy based upon that. Okay, and all of this is time series. We're regressing stuff through time. And then we talked about the cross-section. And the cross-section, in terms of asset pricing, we explain why one stock behaves differently than another stock in terms of its risk exposure. So it's elasticity. Okay, and we talked about that. So we could actually go, and I argued that, that probably the best way to do that is to make sure the risk exposure is changing through time to give the fairest possible chance to the simple asset pricing models. Okay, but we went way beyond that stuff, and it kind of like reached into kind of the last part of the course on selection of securities, where we talked also about a cross-sectional prediction model, where we're regressing at one point in time on attributes for either portfolios or individual securities. And these attributes are going to be lagged. So we're trying to predict the winners and the losers. And I went through and I showed you, I made the case that there were things that we could learn from asset pricing theory to adjust the attributes, like the price to book ratio is the one I used as an example, to adjust the attributes in a way that would improve the cross-sectional predictability, to put everything on the right footing. And we studied this kind of cross-sectional regression methodology. And as soon as we're done with that, we jumped into the selection exercise where we did something simple. We just sorted on individual attributes. We spent 2 lectures dealing with different sorting algorithms and how to put these sorted returns, these portfolios together to achieve performance over and above the benchmark. And we talked about long-short strategies in actually doing that. Notice that I didn't actually, for any of those strategies, run the optimal attribute adjustments. Just used individual countries and unadjusted attributes. With the unadjusted attributes, we saw that there was an ability potentially to create a lot of alpha. And I showed you some emerging markets, and I know I could tell, comment to the left, comment to the right. Yeah, this is true for Malaysia, but we're not going to be trading in Malaysia. Right? Or we can't repatriate the money anyways. But it's not just Malaysia. And I showed you results for the US, where potentially there was enormous alpha that could be obtained with a fairly simple exercise based upon expectational data and doing it all simultaneously. Okay, so the selection stuff is at the end on purpose. Okay, I wanted to give you the asset allocation framework, and I wanted to challenge you to think beyond the traditional mean and variance, to think about skewness and stuff like that. But when we get to the end, we talk about the selection. And once we've selected our securities, then we have to kind of revisit the asset allocation. The allocation that you've been working on in assignment 2, assignment 3, assignment number 4, assumes that you're investing in benchmarks within each country. So UK, you're using the UK MSCI index. But you'd be running a selection algorithm that puts together a portfolio for the UK that looks much different than the MSCI UK. So the key is to use that. That's going to be very important, because it doesn't make any sense to be allocating perhaps, you put a 0 on the UK, right, because of the forecast of the benchmark, but your selection ability suggests that there's going to be a good return to the stocks that you actually select in the UK, and you're not going to be buying the benchmark. So that's got to go back, and you have to revisit your actual allocation as a result of that. Okay, these things cannot be separated, just like the FX. So the FX you allocate, and then you say, okay, well let's hedge out the currency. Well, I don't want to see the situation either where, okay, you run our global allocation, we get weights for different countries, and then we farm out to some equity manager for the UK and let that manager select the individual equities. That doesn't make any sense if there's a disconnect like that. We need to know basically what the strategy is of that equity manager in the UK. I need to see the simulated portfolio returns historically, and those have to go into my optimizer. Okay, are you going to basically go down a road where you don't want to go down, of inconsistency in the basic structure of your asset allocation? Okay. The last thing that I want to say is beware. And I said this a couple of times during the course, that we talk about optimal allocation, we talk about mean variance. We already know that our mean variance portfolio is not necessarily mean variance skewness portfolio, right? So if we just operate in mean and variance, that's not the whole story. The other part of the story is that we're being myopic in doing all of this. That we're considering like one period ahead, and then after that one period, we're going to re-optimize. And there's this theory of dynamic asset allocation. There's some readings that are available on the CD-ROM on dynamic asset allocation. It's mathematical, it's technically challenging, it's difficult to implement today. But as our computers get faster, we will have the ability to do this in a dynamic way. And really what it means is kind of like work backwards. Okay, so given some objective from 5 years, you actually go backwards and look at the different paths and possibilities. You introduce complexity, like what your income stream looks like your labor income, age, all other opportunities that are available, and you form a dynamic asset allocation, and that is optimal. Okay, so when we say optimal in this course, it means optimal given the assumptions. Given the assumptions of mean and variance, and whatever that implies for utility, and optimal in terms of the rebalance and re-optimization happening in a static way, not a dynamic way. So you see some website advertising the optimal asset allocation. It's just not the case. In a dynamic sense, that's not the optimal asset allocation. So be careful with that. And the other thing that you're going to see, and for the webcast students that have been in this course before, okay, sat in this room, this is not a one-off course. Okay, there's certain ideas here that are going to be around in 5 years, but a lot of the stuff turns over very quickly. If you look at my historical syllabi, you'll see just dramatic changes in what I teach. Okay, So this is also the kind of course that you need to constantly replenish. It sounds like I'm plugging the webcast for you later on. You're right. You're definitely right. But there's no reason to think that this kind of course, you take it once and then that's it. Because stuff changes, and it changes very quickly in this particular course. Other courses that are more principle-based, that's not the case. But for this course, it is not a static course, it is a dynamic course. Okay, so I will send you by email tomorrow the order of presentation for Thursday. And remember, rehearse it. Please rehearse it to make sure that you're within like 7 minutes. And we'll have a little time right at the end of the course. We've got to do evaluations, stuff like that. And I'll do a little more of a summary. Okay, so we'll see you Thursday.
Good job.